Let's check in with the Money Desk. Devin Murugan joins us. And Devin, as we battle with increasing costs, the weakening rand is not making things any easier, is it?
No, it's not. Good afternoon, Masejo. I mean, the local currency looks set to breach 17 rand to the US dollar. In fact, just minutes ago, it had touched the 15 rand to the dollar mark. The local currency opening the week continuing its decline against the greenback, Masejo. And this dollar has been strengthening as fears of a global recession intensifies. Many investors feel the global economy is not growing, and what do they do at those times? They run over to a strong currency where interest rates are going up, in this case, the US. The weakening rand, I need not tell you, spells bad news for next month's petrol price. Food costs are also under risk. Iraj Abedian is the chief economist at Pan-African Capital. He joins me now. Iraj, thanks very much indeed for your time. I mean, we've got such an affordability crisis, if you like, at the moment in South Africa. I wouldn't imagine it's any different anywhere else in the world. But I want to talk about this rand. I mean, the fact that we've hit 17 rand to the US dollar just minutes ago, how significant is that to inflation? Can we expect things to go up?
Absolutely. It's very significant on many fronts. One is the fact that imported inflation, most prominently the price of petrol or fuel broadly, is going to go even higher. And the pressure on the cost of living, on consumer price index, as well as producer price index, is going to be quite elevated for a time to come. On top of it, the secondary impact would be whatever you want to transport around the country, whatever you are importing and transporting is going to have a compounding effect. So we're going to feel the ramifications or the secondary and tertiary effect of this depreciation in the currency quite sharply. That in itself raises another issue. Why is our currency depreciating at the rate that it is now? And that has to do really with two factors, broadly speaking. One, the fact that our energy is not reliable, so mining cannot continue and export, and therefore our export earning is going to suffer, which means the availability of foreign exchange or hard currency in the country is going to suffer, and that is in anticipation of that the currency is declining. And of course, globally, the second factor is that the global contraction, or if you like, a stagflation, is also looming large, and that means demand for commodities is likely to also decline at the same time.
That's very significant, Iraj, because through this entire few weeks when we saw this rand declining, you had different commentators say, well, look, there's not much we can do because we are at the mercy of what is happening globally. As the dollar strengthens, by extension, the rand weakens. But you're putting it to me that a lot of what's happening with the rand, or a significant amount of it, lies with sort of investor confidence at the bottom domestically. Because as you say, if we're not getting more commodities out to export as a result of what's happening with our infrastructure and taking advantage of the commodity cycle, again, that's shooting yourself in the foot. Your currency will take a hit. So there's a fair degree of domestic blame to this, is there?
Absolutely. Not just a fair amount. I would say 70, possibly 80% of it is domestic, because we have a very bizarre situation that our miners can mine, the commodity cycle is in their favor, but Transnet cannot carry it to the port. The port cannot handle it, and electricity is not there to sustain it on a reliable basis. Our farmers are producing, but again, they are disrupted. Their packing and transportation is disrupted by the lack of electricity and the port operations. So in my estimation, Devin, on the scale of 0 to 100, 70 to 80% of it is only homegrown. And that's because government has gone to a paralysis of decision making. And Minister of Energy must carry, together with the President, a greatest or the lion's share of this blame.
And as we speak, Iraj, you're starting to see those protests. I mean, you know, you've had this N4 blockade specifically as a result of what's happening with fuel prices. You've got a very restive community base sort of playing itself out in protests because of food prices. Government comes in, they say we will intervene on the petrol price by giving you a bit of a relief on the general fuel levy. It seems to me, though, that there's just so much they can do on that front. They've got to change an entire structure here, because on the ground, price increases are really beginning to frustrate, and it's beginning to show out here. What's the best possible move? And I ask you because you've been involved with government policy in the early 2000s. You kind of know the setting here. What isn't it that government should be doing?
I think we need to split the problem that we have into three compartments and deal with them all three at the same time as a matter of urgency. Some of it, like the subsidy of price, bringing alternative sources of generation in the short term, at the same time investing in diversification of our energy, reliability of our energy, not to another khosla and another paper, today, and treat it as a national priority. At the same time, on the transportation side, Devin, you alluded to my involvement back in 2008, that is 14 years ago. There was a plan to reduce dependence on road, invest in rails, improve harbors and connectivity across the country. That hasn't happened unless we deal with the issue of efficient and green, call it, or if you like, less dependent on carbon footprint and coal and so on and so forth. We need to get our transportation system a lot more railway-based, a lot less road, with much less environmental impact and much less reliance on diesel and petrol. But that requires action, not analysis and the situation that we face now, that there is a paralysis of decision-making in the cabinet, which is highly unfortunate.
Yeah, just before I let you go, Iraj, so we've got, what, 3 weeks left, maybe 2, on that Reserve Bank decision on interest rates. I'm looking at the rand, I'm looking at inflation, and it looks like it might not even be 25 basis points. We might just have half a percentage point up on our interest rates. That means more payment for my car and my home. How do you see it?
I think that is a foregone conclusion on two fronts. One is that the international interest rate cycles are on the up. Federal Reserve Bank is bound to increase interest rates. Other central bankers do. And our central bank has no choice but to keep up with that global interest rate cycle. At the same time, if the Reserve Bank does not do it, the depreciation of the rand together with widening interest rate differential will create more pressure on the currency, because the bond market will exit even more, and therefore you'll have far higher levels of inflation than we experienced, which would be devastating for the working class in particular. So we are facing a very, very difficult macroeconomic environment, and I have absolutely no doubt that the Reserve Bank almost has no degrees of freedom, no choice other than increase the interest rates by 50 basis points and possibly more, unfortunately.
Well, I'm going to leave it there. Chief Economist at Pan-African Capital, Iraj Abedian. Thanks very much indeed for your time. Well,